Good afternoon. Welcome to Japan Society. I'm Moto Sakurai, President of the Society. I'm very pleased to welcome you to the discussion with Professor Alan Blinder and Dr. Gillian Tett. They will be providing their thoughts on the current world economy and whether the next financial crisis is on its way. Before we begin, we'd like to thank each of the sponsors that make these business and policy programs possible. Global leaders, Citi, Deloitte, and the United Airlines, and the corporate partners, Mizuho Financial Group, and the Toyota Motor North America. Now it is my pleasure to introduce today's discussion, Dr. Gillian Tett. Dr. Tett serves as the U.S. Managing Editor at the Financial Times. In addition to leading the Financial Times editorial operations, she writes weekly columns covering a range of economic, financial, political, and social issues. So, without further ado, ladies and gentlemen, please join me in welcoming Gillian Tett.
Well, thank you very much indeed, Sakurai-san, for that kind introduction. And I should say that to be here today and have a chance to interview Professor Blinder for an hour is truly a tremendous treat. He is a luminary of the American economic policy-making world. He's currently a professor at Princeton. He served as vice chair of the Federal Reserve, so we're certainly going to talk a lot about central banking. You've also been in the Council of Economic Advisors in the Obama administration? Clinton administration, sorry, Clinton administration. And you've been a key figure and a key contributor to the economic debate for many years through your books and through your op-eds and your speeches. So it's great to have you here. It's even better to have you here right now for two reasons. Firstly, we now are marking the 10-year anniversary of the great financial crisis. Although there was an explosion of commentary in September about this, in many ways, December is another point when a lot of issues were being actually implemented and strategies were being drawn up in response to the crisis. So it's a great moment to step back and say, have we learnt the right lessons, and is the financial system safer than it was 10 years ago? Or are we heading for another financial crisis? The other reason why it's fantastic to have a chance to talk to you, Professor Blinder, is that this little thing called the Fed is a rather hot topic these days, at least when it comes to the president's Twitter account. I mean, who would have guessed that we would have a world where the Fed chair is suddenly regarded as such an incredibly exciting topic of interest that the president is out tweeting his displeasure and then giving interviews to the Washington Post, saying that I'm, quotes, not a little bit happy with the Jay Powell, even though he chose him. So we live in some rather unconventional times.
We do.
We do. Were you surprised when you saw that?
No. But half that answer is nothing that comes out of Donald Trump's mouth surprises me anymore. It was, as you said, it was only a matter of time. He seems, to the extent I can figure out what goes on in his head at all, where interest rates are concerned, to sort of have the real estate developer's view of the world, which is interest rates can never be too low. And any time they go up, that's a mistake. Now, it would be nice if we had a president of the United States who could actually act like a president of the United States and ask himself, is this good or bad for the United States of America? And if you ask that in a halfway intelligent way, it's pretty clear that interest rates had to come up from the floor. They were sort of wildly low for a good reason. And the Fed always used the word normalization, and they're still normalizing. Interest rates are still pretty low. But so if you took the viewpoint of have these Fed hikes been in the national interest, it's hard to come up with a no answer in a rational way, but if you look at it through the lens of a real estate developer, these are bad.
When you were vice chair of the Fed, which you were for 8 years, is that right?
No, a year and a half.
A year, okay.
A year and a half.
Were you, did you get criticized by the president, by the White House? What were your interactions like with the White House?
No. The interactions with the White House were, first of all, minimal. Secondly, cordial. I was at you mentioned I had these two jobs. I transited from the Clinton White House, the Council of Economic Advisors, to the Fed. And in that first job, a bunch of us, led by Bob Rubin, I don't want to take credit for this, but it was all of us. There was no division of the House, convinced the new president, Clinton, in 1993, and especially in 1994, when the Fed started raising interest rates, to not browbeat the Fed. When Trump started browbeating the Fed, the initial flurry of media stories was incorrectly saying this is like unprecedented. The truth is, if you look at US history from Clinton backwards, it's hard to find even a single example of a president who didn't browbeat the Fed, Democrat or Republican. George H.W. Bush, may he rest in peace, who just died, was doing it constantly, mostly through surrogates. It wasn't he, but it was every other important person in his administration. Nixon, of course, and Burns. Okay, now I've said that. I don't need to go any further. He didn't need to browbeat the Fed, let's put it that way. Lyndon Johnson invited William and Chesney Martin down to his ranch in Texas to barbecue him. There's a whole history of that. We in the Clinton administration convinced a very smart president named Bill Clinton that this was a foolish thing to do, that the Fed is independent, that they're doing a good job, and that if anything, this was going to get their backs up and make monetary policy tougher, tighter than they otherwise would. And I can tell you, I'm the one in one of the early, I'm talking only, this is really not out of school, I think it's been written, in one of the early briefings of the president-elect. Think about what happened. You've gotten to be president, or you're elected president of the United States. You feel, well, that was quite an accomplishment. I was the one that told him when it came to the national economy, he had just been elected to the second most important position in America, and the first was held by Alan Greenspan. I remember the look on his face. But he internalized these kinds of arguments. He's a smart man, and so the result was the mantra of the Clinton administration when it came to the Fed was, we don't comment on the Fed. Notice it's not, we applaud what the Fed did, because then when you don't applaud it, you've made news. It was, we don't comment on the Fed. And Clinton just stuck with that religiously.
So do you think, and we are going to come on to the financial crisis in a minute, or the financial system, but before we do, because this is related, do you think that what the president has done in terms of attacking Jay Powell so personally is going to firstly undermine the credibility of the Fed and undermine the position of Jay Powell? I mean, is it going to be possible for the Fed to keep an entirely neutral stance now?
I think it'll be a little harder. I don't think he's undermined the credibility of Chairman Powell one iota. Because remember, I'm talking to the Financial Times here, for the most part, in the case of the chairman of the Fed, that means in the financial markets. Mm. If you go out on the street here and ask who's Jay Powell, he will have very little name recognition. So for the most part, you're talking about credibility in the financial markets, and it's not going to damage that one iota. What does get damaged is the credibility of the President of the United States.
And do you think the Fed's going to tighten more rapidly in response, just to show that it's independent?
I think probably not, but if anything, it tilts in that direction. I think, I don't think it would be Powell, but I think if they start, when the debate starts, and it's coming, we're not there yet, about when to pause and see what happens. There will be voices around the FOMC table, not Powell's, that say we better not do that so soon because it'll look like we're caving to Donald Trump. I don't think Powell will make that argument, but somebody will.
So a bit of an own goal. I mean, do you think, because some people in the market said, well, Jay Powell blinked this week in the face of Donald Trump, and that's one reason why, he changed his comments.
I think that's completely wrong, and it's an illustration of the standard overreaction to everything that you get in financial markets. What Powell said, he tweaked the language ever so slightly, and of course the financial markets are really paying attention to that. But the message that he gave was very similar to what he's given before, what Rich Clarida had given and other Fed people had given, which is basically, if I put this more frankly than Fed people do, but I can do that now, we want to get up to the neutral range relatively quickly, and then sort of watch and make judgments on an ad hoc basis, meeting after meeting, about how the economy looks, how inflation looks, what we think we should do. And what got lost in that, but it was part of his statement, is that range, if you look at the so-called dot plot, the last time the Fed issued one, is 100 basis points wide, from 2.5 to 3.5. Now, people in financial markets fight and die over 12 basis points or 5. 100 basis point range is a huge range, and we're not quite there, but are almost there. So the markets were correct to read that to say, this is me speaking, not Jay Powell, moving up the next notch to 2.5 is in the bag. And after that, nothing's in the bag. We're going to see how things look.
But another way to interpret that, and I say this will feed into financial policy in a moment, is that basically the Fed has unleashed this unprecedented experiment in monetary policy in the last 10 years to try and save the financial system. It pumped in extraordinary amount of liquidity into the markets. Mm-hmm. The balance sheet went from 800 billion to 4 trillion. Around the world, you've had this incredible explosion, particularly in Japan, but not just in Japan. And it's tipped us into completely uncharted territory where, frankly, no one knows what's going to happen as the tightening continues. I mean, Rich Clarida actually said a couple of weeks ago that the Fed right now, when it looks at the economy and looks at the financial system, is like somebody stumbling around in a dark room trying not to stub their toe, which I thought was rather a lovely image, but not terribly reassuring, given that these people are supposed to be in charge.
Right. I never said that when I was vice chairman.
Okay. Rich Clarida currently has a job that you had. I mean, it's honest, if nothing else.
I understand what he means. What he means by that, I think, is a couple of things, one of which is we don't know where the neutral rate is. We don't know where we want to be in that range or even above that range. But they're going to make judgments about that as it goes along. But the more fundamental thing is, to me, is that the Fed has a pretty good idea still. It's not a precision instrument, what rising real interest rates mean for the real economy. So they affect investment, they affect the stock market, they affect housing, they affect the exchange rate. All of those things look still to be true, and the Fed is constantly estimating and re-estimating the exact the magnitudes. They can never get it exact. So if you sweep away all this other stuff and just ask a member of the FOMC, what do you think we're doing, or the Fed staff for that matter, what do you think we're doing to aggregate demand by going up another 25 basis points? I think they will still answer more or less the way they would have answered years ago, before the crisis. I don't think there's a fundamental reason to think that has changed radically. What has changed is what I and many people call the death of the Phillips curve. When I was on the Fed in the good old days, we were working with a fairly reliable Phillips curve, which is what you use to translate from the state of demand or unemployment to the inflation rate. That part looks broken now, or at minimum. What was Clarida's thing? We're in a cloud.
We're in a dark room stumbling around, trying not to stub our toes.
Well, and in the Phillips curve part of it, they are, and maybe that's what he was referring to. But the good news there is that the Phillips curve has died in a nice way. You can imagine it dying the other way. We've got all this slack in the economy, and yet inflation's shooting up. That's the bad way for the Phillips curve to die. It died the wonderful way. We've got this really super tight labor market, and yet we're not getting inflation. You know, as they say, there are worse things to worry about.
Well, let's worry about something else then, which is what this era of super loose monetary policy has done to the financial system. Because in Japan, it's obviously been extremely distorting. You've had parts of the Japanese government bond market which appear to be almost frozen. You have the Bank of Japan owning a large chunk of the equity market and the ETF market and shaping prices every time it does anything. You know, you've got tremendous distortion. And in the US, though, you've also got distortions, slightly less visible. Are you concerned about these distorting impact of super loose monetary policy on finance?
Not much, a little. I mean, it would be better if, I exaggerate slightly, nobody could borrow at zero. Nobody's really borrowing at zero, but people that want to borrow for various reasons can still, if they're reasonably creditworthy, borrow very cheaply, and that's probably not the greatest thing. But in sharp contrast to the Bank of Japan, the Fed was under, and still is, very severe legal limitations on what it's allowed to buy. So when you speak of market distortions, the only market it really distorted directly was the MBS market, which, how shall I say this, really needed distorting back then. It was pretty wildly...
Those are mortgage-backed securities, the housing
mortgage-backed securities.
Bonds linked to housing.
It was crazily oversold. There were no buyers. The Fed came in as a buyer of last resort. The truth, as many of the people in this room know, and especially bankers in the room, is that not that much of that underlying paper went bad. Some did. But in retrospect, and I would argue in prospect, when the Fed started buying, the prices of MBS and related securities were kind of crazily low. And if the Fed was a hedge fund, they would have said, this is a great buying opportunity. I can make a fortune on this. And by the way, they did make a fortune on this. I remember a conversation when he was chairman of the Fed. I don't think I'm portraying any Fed secret. No, I know I'm not, because it's public information. With Ben Bernanke, who's a dear friend of mine from Princeton days. And he told me, and I was actually shocked. I shouldn't have been. He said, I don't remember what year this was, after the crisis had passed. He said, there's not one single asset in the Fed's portfolio whose market value is lower than what we paid for it. And I looked at him, I said, I sure wish that was true of my portfolio. Never mind that the whole portfolio was in the red. There wasn't a single asset in the red.
Ben Bernanke, the great portfolio manager.
He was.
What year was that?
I don't remember what year. It was after the crisis had passed. Let's say it was 2011 or something. I'm not sure.
Right.
No, it was not true at the worst of the crisis.
Well, given that he's now free to speak, it'd be fascinating to know whether he'd sort of talk about that, because it's, very striking. But just going back to the present point now, where we are with finance, because, one consequence from the fact we've had this economic boom, we've had real rates that have been negative, even in the US until very recently, and financial conditions index, which, if you believe the Goldman Sachs calculations, was getting looser and looser until quite recently, even as rates went up.
Right.
So you've had everything in place for, frankly, a massive bubble. Do you think we're in an equity market bubble right now, or an asset price bubble?
First, let me preface this by the ritual remark that nobody can know the answer to that question.
Okay,
That
but you may have a
includes
better
me.
idea than most. So,
But that said, I'm a little skeptical, and I'll tell you why. Let me make another proviso. That doesn't mean there isn't any, I don't mean to say there isn't any bubbly asset or asset class anywhere. Cryptocurrencies might be a great candidate, for example.
well, not anymore, given how they've collapsed.
Some parts of the commercial real estate market and maybe some of the leverage loans, CLOs. So there are bits and pieces. But if you think of the very, very big markets, like high-quality bonds and equities, they're generously priced. So I can see why some people are saying the odds that the prices go down exceed the odds that the prices go up. But I don't have a big quarrel with that. But I don't see really bubbly behavior. Take American equities, right? I don't keep score on a day-to-day basis, but basically from January 1st to today, it's flat, roughly. That's not the way a bubble behaves. I mean, I teach a little bit to my students about bubbles. And one thing that I teach them is, not that you can predict them, but that they tend to go like this in their late stages. They're accelerating into the crash, almost always. And this is the New York Stock Exchange doesn't resemble that in the slightest, and neither do house prices, though there has been a recovery from the bottom.
What about leveraged loans? And because Janet Yellen recently came out and sounded alarm bells about that. Even Jay Powell last week said that he was concerned about. He pointed out the leveraged loan market has boomed. Covenants, protections for investors have collapsed. Is that?
Yes. And many people would put leverage loan. If you make me make a list of what are the things in the financial sphere I'm worried about, that's sort of probably at the top for me. But the top doesn't mean it's up on the ceiling. It's nothing like MBS and things like that were in 2008. A couple of things to say about leverage loans, which are worrisome. Most of these things that are called leverage loans are not actually held on the balance sheets of banks. So that's good news. It's not the only thing that you worry about in a financial crisis. But if that market should tank and large losses were suffered by hedge funds, which are not very leveraged, because that's their own money, and they're not going to leverage 40 to 1 on their own money, and family offices and sovereign wealth funds or whoever's owning these, that's not the worst thing that could happen. That's sort of analogous to, although it's not the same as, an equity crash. We've had some pretty big equity crashes with very small repercussions. So I use the banks as central, but what I really mean is substantially leveraged financial institutions. As far as we know, they don't own too much of that. Secondly, as far as we know, and here I better knock on wood, because I sure hope this is true, there is no mountain of derivatives built on the CLOs the way there was on the CDOs, on the MBS, and then the CDOs, and then the CDO squared, and then the CDS, and then the synthetic, and it goes on and on. As far as I know, there's no such parallel to that. If there was, I'd be scared out of my mind, because to me, that was the biggest surprise when in the beginning of the financial crisis. As far as I could tell, nobody, now I'm sure there was some really smart guy at Morgan Stanley or Goldman Sachs that saw all of this, but it looked like nobody had any idea how big that inverted pyramid was. You may remember at the time both Hank Paulson and Ben Bernanke said, maybe they coordinated with each other, I don't know, said, you know, this market, subprime mortgage, is only $200 billion. A mediocre bad day on the stock exchange destroys more than that. But what nobody saw was as you went up the inverted pyramid, you were getting into the multiple trillions of, let me just call them all derivatives. They were all complicated things. I don't believe there's any parallel to that now. I certainly hope there isn't. If there is, it's pretty well hidden.
Yeah, I would say, I mean, I would actually agree with you on that, but I would just say that I remember very clearly because I was covering the sector at the time and writing about it obsessively.
Yeah.
And I remember when Bernanke came out and said that there were only going to be $25 billion worth of losses in subprime, thinking, hasn't he spoken to the BIS, the Bank for International Settlements? Because there were voices warning about this, particularly the BIS in Switzerland, but they tended to get sort of basically either ignored or sometimes actively shut up. And, you know, part of the story of what happened in the financial crisis is a story of, if not censorship, then self-censorship and people who weren't really interested in looking in dark places. Do you think that's changed? Is there more willing to tolerate dissenting opinions?
I think it's changed a lot, but let me give you a slightly nuanced response to that. If you could make an index of ignoring risk, it was way, way high in 2006-07. It then plummeted into the basement in the depths of the crisis when nobody would take any risk at all. Dodd-Frank tried to put a little stopper on it to keep it in at least the sub-basement or only on the first floor. And I think it's had that effect. But gradually, I want to invoke my patron saint, Hyminsky, gradually markets forget about these things. And it's exactly the kind of behavior that, I don't want to call it willfully ignoring, it's sort of reflexively ignoring risk that gets you into bubble troubles. And we're starting to move back in that direction. But if I take my analogy that, you know, whatever, in the financial crisis, we were on the 50th floor, and then we went to the sub-basement. I think we're only on one of the single-digit floors now in this imaginary skyscraper.
But a group like the BIS, who did predict the financial crisis and pretty much the only voice on the international monetary stage that did, you know, they are now issuing very concerned warnings, saying that the world is drowning in debt. You know, debt to GDP ratios in the world today are 217%, up from 189% at the time of the crisis. So debt is going up globally, particularly in China, but not just in China. Interest rates have been rock bottom low. They've distorted financial markets. They've encouraged more risk-taking. I mean, the BIS would say this all looks like a pretty nasty cocktail if you look out over the next 5 to 10 years. Would you agree?
Not entirely. And much as I respect the BIS, it's a great institution, they have a history of seeing bubbles everywhere. A recent history, I don't know, about 1942.
I don't think there was a bubble around then, but yes.
So it's their perspicacity about the great crisis, and they should get credit for that, is a little bit like the clock being right twice.
The stopped clock being right twice a day.
Yeah, a little bit. I don't want to. I don't want to downgrade their analysis that much. But I guess what I really mean is when I hear warnings about bubbles coming from the BIS, I apply a discount factor.
Okay. Crying wolves.
So they get the direction right. It's like my view of the financial markets. They get the financial right, but they always go too far. So the BIS gets the direction right, and there is more debt. A lot of that is government debt, by the way. But they're a little bit alarmist. I think, if you think about the two big places, the United States and China, say, I don't really worry about this that much in the United States. In a lot of American institutions, leverage is way down from what it once was. The government debt, of course, is way up. That's a whole different story, but I don't think any sensible person should be worried about default risk on the federal government's debt. That's even with Trump in the White House, I think that's a crazy thing to worry about. And then there's the Chinese who are sitting on a mountain of debt. Their big banks are sitting on a mountain range of bad loans. But Sherlock Holmes would have said it's a capital mistake, right? It's a capital mistake to think of them as being like us. So if something like that would happen in the United States, you might worry about whether Citi and JP Morgan and Wells Fargo and Goldman Sachs are going to go under, as people did worry in 2008. But the Chinese are not going to let that happen. It's not a market economy in that sense. If the government wants to control something, it just seizes control. And they have the wherewithal. They've got the money. So they got the money and they have the, quote, legal authority. They don't worry so much about legal authority. Remember, Ben Bernanke said we didn't have the legal authority to save Lehman Brothers. You will never hear that from a Chinese leader. If they have to seize a big Chinese bank to keep it afloat, they will just do that.
Well, I remember very clearly someone from the Fed who's remained nameless soon after the financial crisis telling me that the problem with trying to cope with the financial crisis is it's rather hard in a democracy.
Yeah, exactly. But the flip of that is it's easier in a dictatorship. Not that I'm advocating dictatorship.
Even coming from the central bank, even coming from someone who thought the central bank governor was more important than the president of the United States. I'm told Bill Clinton that. But, I mean, on a serious note, so you're not too worried about the equity market. You're not too worried about leveraged loans because although they are becoming potentially risky, they're not held by banks and there don't appear to be lots of derivatives there. You're not that worried about US government debt, even with Donald Trump in charge and cutting taxes and raising that debt. Yeah. And you think the Chinese debt is kind of okay because the Chinese can just, order the system to heal itself as it's needed. So is there anything on the financial system radar right now which worries you?
Sure. The first thing is always, but this is an empty remark, the thing you don't know about and aren't thinking about. So I know there's something I don't know about and I'm not thinking about, which I should be worrying about, but I'm not smart enough to see it. Things that you can see on the radar. I don't think the business about Brexit is over.
Yeah, tell me.
I don't pretend to know.
I work for a newspaper that's headquartered in London. It's impossible for anyone to be in London to be not completely consumed with Brexit, given that the vote's going to be in 10 days' time. It's going to be a pretty grim Christmas, whatever happens.
But we over here think about it a lot less.
I know.
It's still a significant.
Thankfully.
It's still a significant risk. I don't think Greece is over. People just completely forgot about Greece. Greece now has, you probably know, 170%
debt to
GDP ratio or something.
Yeah, it makes Japan look positively modest.
Yeah, I mean, that's not remotely close to sustainable, and we don't know what's going to happen with that. The European banks, a lot of them are not in fabulous shape, not like the American banks that are in much, much better shape. And that's a big deal, and those are democracies. So it's not going to be that the leaders of those countries just say, I'm grabbing hold of this bank and throwing in whatever money is necessary. They don't do it. They can't do it that way. I don't know what's going on in France, but it doesn't look very good. And then there's Italy, which also doesn't look very good. So there's a whole long worry list just in the advanced world. And then there's a whole lot of other countries which are probably not systemically important, globally systemically.
And what about the financial institutions? Do you think they're strong enough now to cope?
Well, that's why I brought up the European banks. I think the American financial institutions probably are.
Yeah.
Again, you worry about a skeleton buried in somebody's closet that I don't know about. But I think there's a good chance that they are. They have a lot of loss-absorbing capacity. Now, it's not so clear that the Europeans or European bank, the big European banks, are in such good shape. They're certainly not making the kind of profits that the American banks are.
I mean, what would worry you? I mean, there are groups like Deutsche Bank, which are facing challenges on many fronts right now.
Yes, you might say that. I was not referring to the challenge of the police vans arriving at the door, but they've probably made a lot of loans that, well, I was going to say they wish they hadn't. I don't know what they wish, but. And just in general, I don't want to try to name names here. The European banks have not gotten over the crisis as thoroughly as the American banks. Because after all, look, as they were getting over the crisis that we got over so beautifully, they got hit with Greece, et cetera, and the Eurozone crisis. You know, we shouldn't be too smug in America. Suppose something like that had happened here, our banking and financial system wouldn't look as good today.
Well, something did happen. You had Puerto Rico, but the Treasury just ignored it.
Yeah, and, no, that's right. And relative to the United States, this was very small, which is why they could ignore it.
I'm going to turn to the audience for questions in just a moment. But before I do, I'm just curious, any views about Japan, since we are in the Japan Society, about, whether it's time for Japan, the Bank of Japan, to copy the Fed and start normalizing policy more aggressively? Do you think the Japanese banks are healthy these days? Do you think it's a good idea to have an equity market which basically moves based on the cycle of when the Bank of Japan will next buy another ETF?
All right, so that's a whole passel of questions. Let me start by by saying
I'm sure the audience would love to hear.
I've been baffled by Japan for some time now. The Bank of Japan has, so to your question, do I think it's time for the Bank of Japan to reverse field and start normalizing? No. The Japanese economy, for reasons that are still somewhat mysterious to me, given all that the Bank of Japan has done, has not staged the kind of robust recovery that we, not to mention the Japanese authority, would like to see. So no, I don't think the Bank of Japan should compound the error that it made a long time ago by being too late to start doing important things, by being too early to start taking them away. So that's the one part of your question I feel confident about. Is it a great thing when the central bank owns a significant share of the national equity market? I don't think so. Not in a capitalist democracy. In other kinds of societies, you can imagine so, but Japan is a vibrant capitalist democracy, and all else equal, it would be better if they didn't own that. So if I were running the Bank of Japan, a fanciful thought, that would be high on my list of normalization things. They've got when the time for normalization comes, they've got a lot more to work through than the Fed ever had.
Yeah.
The Fed's list was relatively short, and it took one of the things right off the list, like MBS. Are we going to unload the MBS? No, they said, we're not going to unload the MBS. So it was a relatively short list. The Bank of Japan has a really long, complicated
Nobody has ever got out of an equity market on this scale smoothly.
That's probably right. That's probably right. But of course, you could broaden that to say no central bank has ever normalized on this scale. End of stat. You don't even have to put in the adverb smoothly at the end.
Yes.
It just never happened. It never happened before. So it's going to be a tough road to hoe. But I've just found, to me, it's still somewhat mysterious why the Bank of Japan has had so much trouble creating a minimal amount of inflation in Japan, given all that they've done.
Well, yes. Well, it seems a good moment to turn to the audience for questions. It would be courteous, but not completely compulsory, to identify yourself. Please keep your question or comment very short, and I hope to get as many as I can in. I can see a number of hands waving already. Question here in the middle, and then over to the side. We have a microphone as well.
Hi, my name is Fleur. I work at Nomura. I would be interested to know more about student loan debt and how the impact that will have on my generation and the next one.
So the student loan, there's this old saying, where you stand depends on where you sit. Student loan debt is a very significant problem for a number of students, especially students that don't actually get a degree. If you actually look at the paradox in the student loan market, I'm not an expert on this, but I know this much, is that the most indebted students, when they finish their education, do fine in paying back their loans. It's the ones with the smaller amount of debt, which they acquired at lower levels of education, not MBAs or medical school or something like that, that have very high default rates. A significant part of that problem is that they went to for-profit institutions of, quote, higher, unquote, learning. So it's a terrible problem for some of these young people. If you look to the financial system, I don't think it's a big worry, because the banks are not holding this, or not holding much of it, and the government is basically holding the bag. So the worst case scenario is that a lot of this paper goes bad, and the US government debt to GDP ratio goes up a notch or two, which we wouldn't like to see happen, but is very far from a calamity.
Got a couple of questions over there, one there, and then coming forward.
Hi, thank you. I'm Ron Mandel from Baruch College, and Professor Blinder, I have a question about the Dodd-Frank Act. One of the things it did was substantially reduce the ability of the Fed to make emergency loans under Section 13.3, whatever. And I'm wondering if you think the Fed could react the same way in a future crisis to save the system as it did in the last crisis.
Yeah, it's a good question, and I asked this to a lot of Fed people, starting with Ben Bernanke. Let me give you my answer. You use the adverb exactly in your question. No, they can't do it exactly. There can be no more AIG and so on. The Fed has to, for those of you who don't know, the piece of the Federal Reserve Act which covers emergency lending at Section 13.3 of the Federal Reserve Act was changed by Dodd-Frank so that the Fed cannot make one of these emergency loans to a single institution, but needs to define a class of, can make it to a class of institutions. I believe the Fed is clever enough when necessary to define a class. So I don't worry very much. Opinions vary on this. You asked for my opinion, I'm giving you mine. I doubt that this would be. I'll give you an example. Suppose AIG should happen again, God forbid. The class of firms that is an insurance company with a large hedge fund sitting on the 14th floor would be a class. There won't be a lot of members of the class.
Well, it's a curious question to ask, but I must say, having spoken a lot to Hank Paulson and Tim Geithner and Ben Bernanke, who were doing their kind of road trip recently as a trio, trying to share the lessons of the financial crisis, the point that they make repeatedly is that they think they haven't got the tools they would need and that they've been taken away.
Yeah, as I said, I talked to Ben.
Is that just them shouting loudly to try and get the law changed? Or
look, there is truth to it. The ability to make pointed 13.3 loans at one or two. I was making a little fun there. If it would only be one or two in the class, I think it would be a stretch. But the nice thing about defining a class, the reason I don't think would be a big problem, is you can define a class that has I'm making up a number just to illustrate, 15 financial institutions in it, but if only 2 of them are on death's door, you're only going to have 2 come in and please give us this money, which is going to be lent on Badgett-style terms. So you have defined the class, but it doesn't mean you're shoveling money out the door to every institution that's in the class.
Right. We have another question in the front, second row there, and then further forward.
Andrew Qualley, lawyer, Sidley Austin. I think the 13.3 question is a very important question because it also depends upon the courage of the people who are trying to decide whether it's legal or not. And as you know, in the AIG case, the court said the Fed acted illegally in bailing out AIG. My question is the short-term liquidity market. That seems to me what really triggers these collapses, Bear and Lehman, and they occur from Wednesday to the weekend, right? And that's the repo market, the U.S. Treasury market. All those markets are less deep than they used to be. What worries you about that plumbing? I call it the plumbing of the financial markets, and I think that's where the risk will come again. And it doesn't require a big problem to have a particular institution not be able to fund itself, and then other creditors say, I'm not going to fund you, and I'm not going to fund you, and you'll have the contagion effect.
Yep. No, it's a very fair point. This depends a lot. You're certainly right about there being less liquidity in a lot of these markets than there used to be. It depends a lot on whose liquidity you're worrying about, because in a number of cases, the discount window is available. The tripartite repo system, for example, is smaller than it used to be, which is the bad news, but it's also the Fed is in there much more. It's much more tightly supervised than it used to be, which is the good news. So it really does come back to the 13.3 questions. Some kinds of liquidity crises, especially if they involve solvent banks, will be easily handled by the Fed. One can imagine if another long-term capital management crisis should come along, and it's that one institution, that the Fed would have difficulty handling it. But I just want to remind you on that, you know this, but the Fed didn't handle that one either. It got the 13 companies in a room, put in sandwiches and locked the door, and said, knock when you're ready to come out. And there's nothing in Dodd-Frank that says they can't do something like that again, fortunately.
We've got a question there, and then go back. And then.
Hi, my name is Yoshi Ikiri from JP Morgan Chase. My question is potential, LIBOR replacement with the SOFR in the United States, with more deep liquid market, and do you think it may impair one of the key tools for Fed to implement the monetary policy? Because as you mentioned, the tri-party transaction in Fed and Fed-related transaction would be exempted or carved out from the calculation of SOFR, and may not move in a similar way as LIBOR.
Well, this is generally a fairly complex plumbing question, but it's very important.
I'm not sure I can give you a good answer to that, except to say that two things. It was not necessary that the world be, or financial world be oriented against a LIBOR benchmark. There are lots of other things that could, in principle, have been the LIBOR benchmark. If you had asked me years ago, this is really fanciful, and also told me what the real story was behind LIBOR, I would have said, my God, don't use that as your benchmark. Now we've learned something and move away from LIBOR. Second thing is that if you put into perspective the very short-term money market, which of course is to many people, that's their life, that's what they do. In the scheme of things, that's a lot less important than longer-term interest rates. I don't mean 30-year, 3-month interest rates, 6-month interest rates, 1 year. excuse me, interest rates that don't depend on this overnight money so much or at all, and can live their own lives without worrying a lot about the overnight money market. But when it comes, but that said, a fraction of the finance is really focused on the overnight money market, and it's a legitimate thing to ask about. But I just repeat what I said, that I think if folks, never mind me, folks years ago had realized where LIBOR was really coming from, they would have organized it in a different way. So it's, to me, a corollary of that is that it's getting reorganized away from LIBOR. Can't be a bad thing.
Right. We got time, I think, for just two other questions. I'll take them both now, but one there and then one there. Let's take them both, because then we can...
Berkshire Capital. I'm wondering why you're so sanguine about the size of the federal deficit. If you looked at the weekend edition of the Business Daily, there was Uncle Sam sort of about to go off a cliff with a big iron ball called the federal deficit on it, on his foot.
So why are you so relaxed about the debt when it's becoming so big? And let's take a question here as well. I'm trying to get as many of you as I can.
It looks like the tariffs with respect to China will be with us for at least 3 more months. Does this make the FOMC's job more difficult? Is it harder to read the tea leaves when those things go on? And how much might have it affected economic growth and inflation to date and next year?
So two small questions. What about the debt and what about the trade war?
Let me start with the trade war.
In 4 minutes.
I can do that quickly because it was asked in the context of the FOMC. For the FOMC, given where we now are and are likely to go, it's pretty small beer. You can imagine a much bigger, worse trade war, and that would be a very big deal. These tariffs and related interferences with trade are like mini supply shocks. They push up inflation just a bit, and they reduce real growth just a bit. But the important part of that sentence is the just a bits. It's very unlikely to have a major effect on the FOMC deliberation. Now, the question about the federal government debt is a much tougher, deeper question. What I said, just to be clear, is nobody should be worrying about the federal government defaulting on its debt. In most bond markets, that's sort of like the #1 worry. Will the debtor actually repay? The debtor, the federal government debtor, will repay in full, dollar for dollar, always, unless some crazy politician decides otherwise. You may remember that Newt Gingrich talked about that for a while in the 90s, and there was one instance where we got a downgrade from S&P, I think. It was S&P, right? Because of that nonsense. But everybody knew that if that happened, it was going to be a one-day default, and then Newt Gingrich or whoever would have made his point, and that would have been the end of it, or at least everybody except S&P knew that. That doesn't mean that government debt should go to infinity. We generally still think that, other things equal, a bigger accumulated federal debt leads to higher real interest rates, and that tends to crowd out things that are interest sensitive, like building and to some extent business investment. We still believe that partly because of that, to the extent that the central bank, the Federal Reserve in our case, is targeting interest rates, and if the bigger deficit is tending to push interest rates up and accelerate aggregate demand, that may induce the Federal Reserve to tighten up faster or more vigorously than it otherwise would, and that's not good. We don't think it's very smart for the federal government, when the economy is operating at peak rates and the unemployment rate is 3.7 or 4, to have a big tax cut to boost the deficit for no good reason except that the donor class of the Republican Party wanted it. That's really not a good reason to do that. So there are many reasons to think that we should not, at minimum, we should not be raising the debt to GDP ratio, which we are, and maybe should be pulling it down, but default is not one of them. The last thing I want to say, let's end on a provocative note.
And then I'm going to say something.
One thing that I've been turning around in my head, but I haven't reached a decision myself, is whether advanced, stable countries like the US and Japan, and I don't pick Japan randomly, can actually bear much higher debt to GDP ratios than we used to think. Japan is the quintessential example of that. Interest rates there are still low, despite a debt to GDP ratio that is way higher than anything the United States is likely to experience in the near term. And the second thing is what's happened to US long-term interest rates on treasuries as the debt to GDP ratio has gone up and up and up. And you could say similar things about European countries.
Some European countries, yeah.
Some, no, I said advanced, stable, well-run.
Which basically means Germany. Well, listening to you for the last hour, it's been fascinating. Part of me listening to you rather wishes that you were still at the Fed, given the wisdom that you bring to bear to the current debates, and given to this wonderful vision I have in my head of you walking into the Oval Office and telling the president that he's only the second most important person in the country. But I'm actually quite glad you're not at the Fed, because precisely because you're not at the Fed, you're able to talk with a frankness and a sense of piercing understanding and wit, which frankly is incredibly badly needed today in America as the country confronts these very serious political economy challenges. So thank you for sharing your thoughts. Please keep speaking out irreverently. And in the meantime, it's given all of us a lot of material for reflection, and good luck to all of you who are in the financial industry in working out how to apply this. Thank you.
Thank you.